Hi there, everybody. Welcome. We're just starting about a minute or two late. We'll just wait for people to join. And apologies for the slightly late start there. Usual technical snafu. And in the other room next to me is my partner in crime, Andrew, our chief investment officer. So we're just waiting for people to sign up now. They're being let in. We'll have lots to talk about today and lots of time for questions. So we'll just wait while people are still joining, and then we'll start in a couple of minutes. You will see in this room, just while we're waiting for people to sign up, that this is one of the rooms we have at Simplicity, which is a real Kiwiana room. We have lots of pictures that they're actually black and white pictures that were hand coloured by artists back in the 1960s, and they used to hang in DB pubs. You can buy them on TradeB now. They're all the beautiful scenes of New Zealand. There's heaps of them there. And then right behind me is our Crownland pottery collection. All of this is from TradeMe, all gifted or donated to us in our new offices. So I think we're just about there now. Pretty much everyone has signed up there. So I'm going to go into a share screen and then just, I only got sort of 4 or 5 slides to talk to today. And then we'll have a lot of time for Q&A on this one, eh? So, but we'll just, I'll go into that right now. Okay, so what are we going to talk about on this presentation? Really just 6 topics, and we'll go through them fairly quickly and have lots of questions at the end there. One is to look at our performance, because you'll see that performance has changed generally in markets and has also been very positive for ourselves. We just want to look at what we've done in 2023 so far, because there's been a lot of changes at Simplicity. All of them are good. And then also what to expect going forward as well from us for the rest of this year. We wanted to talk about unlisted assets, because we've increased our allocation to unlisted assets and why we're doing that. And then talk about a concept that we're starting to bat around here, which is called the Rebel Alliance of Finance. Do we actually need one? And then we'll get on to questions. So let's get straight into it. How are we doing? This is our presentation of our performance of our KiwiSaver funds. And we use just our KiwiSaver funds because there are very good industry surveys where we're benchmarked against everybody else. And as you can see, in the last 3 months, they've all had some very strong performance. Financial markets generally have kicked up because the interest rate expectations now are starting to level out and top out. You'll see that still most of the funds are still in negative territory. It's been a bad year for investment returns generally. But over the 5 years, you start to see, unsurprisingly there, if you're in a conservative fund, you earn less than in a balanced fund and less than in a growth fund. And there you can see what really matters to us is the 5-year performance. As you can see, because we had a lot of long-dated government stock and long-dated investment-grade bonds, when interest rates gapped up, we go through this period of underperformance until such time as they roll off and get paid off. If interest rates go down, our conservative fund should continue to perform well, as it has been recently. But we're in the middle of the pack there for 5-year performance on that. Obviously, significantly better when it comes to the balanced fund, and really, you know, almost at the very top there with the growth fund. Our goal, in spite of the fact that we're a social enterprise and we're owned by a charity and we do a lot of, you know, call it impact stuff, our goal is to make you wealthier. That's what we're about. We think that you can do it primarily by charging the lowest possible fee, and that's why about, well, over 90% of our assets are in passive indexed funds, but we do also think that there's a way that we can increase performance as well by the unlisted assets, and I'll get onto that. But anyway, a period of improving growth. Andrew, did you just want to say anything about what the interest rate expectations would be if we were looking forward about 6 months now? What are the signals we're getting about the direction of interest rates?
Yeah, obviously an extremely difficult one to answer categorically, but it does appear as though we're getting towards the end of the interest rate hiking cycle, and longer-term interest rates have stabilised and actually fallen, if anything. So unless there were to be some other unexpected event over, let's say, the course of the next 6 months to a year, it should stabilise at around where markets are now, which is, from a government stock point of view, about 5%. Okay,
great. Thank you. All righty. And now we'll talk about what have we done so far as a business, because there's been quite a bit of change. Just to recap there, in our
you've gone off.
Oh, sorry. Have I just gone off share screen there again? Have I? Okay. Apologies.
You've gone off share.
Yeah, I'm sorry, Andrew. Yeah, I'm just going to get back on again. Won't be a second, mate. Right, can you see that again now?
Better, that's it.
Great. So as you can see, we've launched new KiwiSaver funds. Members were asking us for aggressive high growth funds, and we actually call it the high growth fund, but it's at the aggressive end of the investment category, and then also a defensive fund as well. And we did that also with the matching investment funds, because as you know, what we like to do is have the KiwiSaver fund and the investment fund with the same fees, same investments. It's just that you can take your money out with the investment funds. It obviously stays in under KiwiSaver. And then we also launched new international savings funds, 2 of them in equities, one of them is fully hedged and unhedged, and then one of them in bonds, global bonds. And that was because of member demand as well. In fact, we have some wholesale clients that wanted to buy them as well. But also we needed them because we were setting them up to bring the vehicle onshore into New Zealand domiciled funds, so that we could fully take advantage of the tax situation and basically remove what we would call a tax drag by having the funds in Australia, which is what we had with Vanguard. We wanted Vanguard to set up funds in New Zealand, or we offered to do them and said, would you manage the money? Vanguard said, listen, love what you're doing, great partnership, but we're not in that business anymore of doing managed accounts. So we then went and found DWS, and we've done a very successful transition. The other thing we've done is in Simplicity Mortgages. We've now been operating this business for over 2 years now. We're getting up to $140 million worth of first home mortgages. We will carry on doing that as we grow. We'll have more money to put into mortgages. It's been very successful in terms of returns, haven't had a single default because it's a very safe, conservative lending book. So that continues to grow. And then we've opened our first village for Simplicity Living in Point England in Auckland. And we have 69 apartments, which we're currently leasing at the moment. And that's going very successfully. So a lot of stuff has happened. Obviously, we've been making all of these investments with the ethical lens that we've had for quite some time now. And we continue to give 15% of fees to the Simplicity Foundation, which is now almost $2 million a year in donations, which is just fantastic. So, but what to expect for the rest of this year? Well, I don't think there'll be anything more with our KiwiSaver and investment funds. We are starting to look at something called Simplicity Income Funds, or we're looking at what could we do to provide a reliable income for people in retirement, because we think people are getting basically ripped off with term deposits. They're not getting paid enough because the banks are making too much money from those term deposits. And also with the mortgages and with Simplicity Living, we have reliable mortgage repayments, we have reliable rent payments. How could we turn that into an income product? So we're looking at that. The other thing we're having a look at also is with the mortgages. We're contemplating, do we take it from variable to 1 year fixed terms for first home mortgages? Do we lend over apartments? There's a whole lot of questions there about how do we grow that business. So we're looking at that as well. And with Simplicity Living, actually what we will be doing is starting construction on 2 new villages. One of them will start in Mount Albert or Oaraka in Auckland. That's in about 2 weeks' time. And then we're also looking at starting someone pending, if we get resource consent, in Mount Wellington, a very large one, about 300 homes there. So a lot going on there as well. I just wanted to talk about why we're investing more in unlisted assets, because we just did an asset allocation change. And we're putting more money into mortgages, more money into build to rent, and more money into private equity and venture capital. So why are we doing that? And I'm very happy to take questions on this when we finish, but I'll just give you some one-liners right now. With mortgages, we now know, we've been running our mortgage book now for long enough, we now know that we are getting better risk-adjusted returns for our members, and we are able to provide lower cost variable rate mortgages for those people who are borrowing from us too. So everybody wins. Well, not everybody. The banks lose because they're not involved in this, but we love that. So our investors win by getting higher risk-adjusted returns. Our members who borrow the money get a lower cost mortgage. We just take the 2% net interest margin there or thereabouts that the banks make, which is the difference between term deposits and lending, and we give that, basically spread that goodness, some to the investors, some to the borrowers. On the build to rent, we're doing it because we think it's a fantastic long-term economic return, very comfortable there. We have a competitive advantage because we buy the land, develop the property, manage it and rent it, get rid of all that phyllo pastry of fees. And in private equity and venture capital, we're doing it because we think as a New Zealand-owned non-profit social enterprise that actually a bunch of businesses would like to have us as an investor. And we also have the patience and we can take play a long-term game here, which you have to win in those games. But we're going to talk about that more later on. The other question we just have right now is, do we need a rebel alliance of finance? I hope you like this. This is the Millennium Falcon that we built in the office. We bought one secondhand on Trade Me, stuck some simplicity stickers on there because we really do sort of think of ourselves as the rebel alliance of finance. But what we're, as you know, we're a little bit of a disruptor. So we like the word rebel. That we're definitely there. We're definitely in finance. But the other key word here is alliance. Are there people that we could be getting together with, doing business with, that would allow us to basically take on what we think are the super profitable banks in this country, which are extracting too much profit out of the pockets of ordinary New Zealanders? Could we all get together and help each other and create what's basically a rebel alliance of social?
You've got on mute, Sam. Hang on a second.
Unmute. Can you hear me now?
Yeah.
Sorry about that. Yeah. So this was, so could we do a rebel alliance of like-minded social enterprises to help look after ordinary hard-working New Zealanders? So we're thinking about that as well. There may be some people that we can work with there. And I think that's about it. I'm going to go right back here actually. Go stop share here. I can. There we go. All right, there we go. So that was our presentation, just very sort of high level things. And because what we wanted to do with this one is leave plenty of questions for members about what's happening with the financial markets, what's happening with simplicity, what's happening with the rental and property markets as well, and the mortgage markets and so on. Just answer any questions that you have. And I see they're coming through. Andrew, I know you're typical the question master here, so could you ask them, and then you and I will deal with them.
And there's some good ones already. Somebody anonymously has asked Kiora, what made you choose a particular global share funds indices which are new? What are you expecting the returns to be, as much as anybody can predict? So as you know, we don't predict returns, but the new indices are, although they appear to be new, the global bond index is actually almost exactly the same as the one that we were using for the Vanguard funds based in Australia. Global shares are designed to be almost identical, if not identical, to the FTSE indices that we were using for the two Vanguard funds. The key being that the screens which exclude the investments that we don't want to make, for example, fossil fuels and weapons, those are maintained. There's been a tiny bit of filling around at the outside of it, but nothing material has changed. And the only other major change to it is that now our Australian investments are included in our international investments. We don't have a specifically Australia fund. We pull those all in together. So and that's made life a bit simpler. I don't know if there's anything you want to add, Sam. I mean, in terms of predicting returns, we expect them to perform better than the unscreened indices, but as to what sort of return you can get from shares over a long period of time, the guide for a 100% growth fund from the FMA is at, I think it's 7.5 after tax and fees is the expected long-term return. So that would be, that's the best we could probably pick.
And I think so. What we did was when we moved to DWS and new indices, what we did back tested them to see how they would have performed versus the ones that we were already in, and they were extremely close. And
very much so. Exactly the same.
So I think that segues into the next question here, Andrew.
Yeah, how much did performance suffer by excluding fossil fuel and arm providers? And that, I mean, it's a great question, particularly over the last little while. In terms of the global bonds, I don't think it will have had any effect at all. I've got a couple of the indices from there, and there's no material change in the global focused bonds. Matter of a few very small percentage differences. For global shares, there has been a difference most recently, as you could sort of imagine, because with the Ukrainian war, the likes of weapons and fossil fuels have performed quite well. In actual fact, more recently, the screened indices have performed better. But if you go back to for a year, for example, make sure I get my numbers right. It's about 1.5% worse off by screening out those pieces of the index. But if you take any longer term, if you move out to, well, certainly for 5 years, the screened indices are still ahead of the unscreened indices. So from our point of view, this is a short-term thing, which it's going to happen occasionally, but the underlying theme is still that the likes of fossil fuels are a legacy type investment, and that we don't want to be investing people's money in weapons.
Yeah, I think there was some sort of there was a few sort of holier than thou statements in the last year from fund managers who were invested in fossil fuels and arms and said, we told you so, as those companies did extremely well. But remember that over the long term, and remember we're investing for the long term. Well, first of all, you don't like fossil fuels because of the carbon imprint, but also these are what they call sunset industries. These are industries that are getting starved of capital because people and us aren't buying them, where demand is going down as people switch from fossil fuel-based industries to alternative forms of green energy. So they are, we think, destined to underperform over the long term. So if you think about it purely in terms of returns, that's what you would do anyway. But then also actually making a value statement about where you want your money invested as well. So and the numbers, as Andrew's shown you, bear that out, right? You can vote with your conscience and also get a higher return, and that's happening. But over the last year, no. Over the longer term, yes. And over the shorter term, yes. Next question, I think. Andrew.
Yeah, next question. Kia ora, what are you, this is from another anonymous person. Sorry, JD, I forgot to mention that you asked the last one. Kia ora, what are your contingencies for a NZ housing market dip, since Simplicity Living is so exposed to this one market?
Yeah, that's a very good question. So Simplicity Living, of course, is a small component of any one of our funds. So it's not as if we've made a major bet on the housing market here, but we have increased our exposure there. And but if you think about how and secondly, you can't protect against a dip in any asset class, right? They go up and down. Unless you want to stick your money in the bank and keep it, just get bank deposit returns. That's the only way that you will protect yourself from the value of your investments going down. Although we would argue that your investments are going down on an after inflation basis. You're not getting adequately rewarded for the inflation risk there. But anyway, let's assume it goes down. How do we protect it? The biggest protection you get when you're investing in housing, in our ways, the way we do it is, first of all, is build the houses for the lowest possible cost. And we're extremely efficient in the way we do that. We build for about $2,400 per square metre versus a market average of something closer to $3,500 to $4,000 per square metre. Ours are also built out of concrete and bricks, so they're actually, we would argue, will last longer than the building code, which only requires you to build a house to last 50 years in New Zealand. But also, obviously, when we have them rented and people will be paying their rents, even though the value of those houses may go up and down on the valuation, the cash flow continues to come. And because the rents are attractive and because the apartments are bigger and more solid and so on, and they're a really good place to live, people will stay in them, carry on paying their rent, so you get the cash flow. So that's how you mitigate the effects of a dip by having high quality property which is very well leased. But you can't stop them from dropping in value at times, and as you've just seen in the last year, they have. After, I would mention, a very long period of going up in value. The other thing I would say about this is that when we do our financial modelling for house price increases, I know a lot of people, in order to justify developing property, assume increases of 5 to 7% per annum. We think that's rubbish. We think houses over the long term, if you're going to invest in them as we do in the long term, you just assume that they grow in value with GDP. So we plug in about 2 to 2.5% per annum assumed capital increase when we do that. And of course, in 50 or 60 years' time, who knows what will happen there, but we're very conservative in our modelling. So next one, Andrew.
Great. Okay, from Matt S. Can you please explain the difference between hedged and unhedged funds, and what are the advantages of each? Do you want me to cover that, Sam?
Yeah, sure.
Yeah. So we're talking about the currency here. If you buy, the simplest one to explain is an unhedged fund. if you put your money in an unhedged fund, your New Zealand dollars are exchanged for all the currencies in the index, so US, Japan, Europe, UK, etc. And so not only have you got the changes in the value of the New Zealand dollar versus all those currencies, you've also got the underlying share markets that you've invested in. If you go into a hedged fund, that currency variation has been taken out. It's a very simple process, requires just setting a rate for a month's time each month. But that takes out the movement in the New Zealand dollar versus the other currencies. And you'd think intuitively that would mean that the hedged fund moved around less than the unhedged fund. But because the New Zealand dollar is a relatively volatile currency by international standards, actually by holding all your money in New Zealand dollars, the values swing around more, because you don't have, if for example, the US stock market goes down, it's very often because people are getting more worried, and so they'll buy US dollars because that's seen as a safer haven, and that offsets some of the dip in the share market. Whereas if you're hedged, you get all of that dip, you get the full movement of the underlying share price. So what we do for all of our funds is we split. We have 65% of the investments in the hedged New Zealand dollar portfolio, because we believe that New Zealand investors should be at least have a reasonable proportion of this in New Zealand dollars. But we also have 35% of the investments unhedged, so that we don't have the full exposure to the New Zealand dollar. And the reason we've picked 65-35 is basically because that's the average of the market. We've gone through everybody else's asset allocations, and that means that we are not exposing you to any more or less risk than everybody else in the market. Does that cover it, do you think, Sam?
I think so, thank you. I'll pick up this next one, Andrew. Oh, sorry.
I was just going to say, if you need more explanation, just flick us an email at info@simplicity.kiwi, and we can go into more detail if you like.
And here's the question. I'm currently in a growth KiwiSaver fund. I've still got 30 years to go. Would I be better switching into the high growth fund for the next 20 years or so? Best thing to do is to go to the website, and there's a questionnaire there. What fund is right for me? Click on that. It'll ask you 3 questions, and then it will give you what in fact, not just us, this is actually from the Sorted website, we've used the same rationale, what they would suggest is the right fund for you. So it may or may not be appropriate depending on your appetite for risk. And then Richard, Andrew, there's a question from Richard.
Yeah, I mean, this is always a difficult one, but thank you, Richard. I was wondering if there's been any thought to allowing KiwiSaver investors the ability to have more than one fund running at a time. I'm in the KiwiSaver Growth Fund, but I'm over 60, and so I want to have a conservative cash fund where I can place investments that I need within, say, 5 years. Hasn't been discussed for a while, Sam, but you've got any thoughts?
No, and what we decided to do this time was open funds on both sides of the spectrum, high growth and then defensive, rather than allow people to have a percentage in this fund, a percentage in others, which I know other providers do. We like to keep it simple for we're called Simplicity for a reason. It's one of the reasons why our fees are so low, is because we keep these things very simple. We think now that people have a pretty good range that they can choose from there. Will we move to that in the future? Maybe. We occasionally get asked the question. The other thing you can do, of course, is that if you are if you're over 60, then what you can do is you can, of course, have your KiwiSaver sort of fund that's appropriate for you. And then when you turn 65, you can take some money out and put it into different funds, either with ourselves or investment funds, either with ourselves or with other managers. So sorry, Richard, we don't have an answer for you on that one right now. Are we likely to do it in the near future? No, because we don't have enough demand for it. It requires quite a bit of changes to our systems. But hopefully by providing you with 5 funds now to choose from and not 3, you'll have a little bit more choice anyway. Can I pick up this one from Martin? Unlisted assets. Are there police that check if you risk veering over to the dark side? I guess this is indeed. There are police that check. It's called our supervisor, the public trust, and they're responsible for making sure that we obviously stick to what we say we're going to do. And I guess their police are the FMA as well. So there's plenty of people looking at what we do. And obviously, when we make these changes, we have to justify it to our investment committee and then to our board and then to the public trust and so on. So there's a whole lot of people that we need to, checks that we need to go through when we make these changes. But I don't think we'll be veering over to the dark side. The dark side is becoming a bank, and I can't see that happening for a very, very long time. It's the next question, I guess, from David. Yeah.
If wealth taxes that are being talked about eventuate and cover all sources of wealth rather than just property, do you have a contingency plan?
Well, yes, in the sense that the contingency plan will be that the wealth tax will be presumably be applied by the government in a fair and equitable manner, or however they want to, and it will apply to everybody. So we won't be able to change our investments to arbitrage out of an individual wealth tax, because it will be on your individual assets. It will look at the individual level. We will just be providing funds that will get taxed according to the law along the way. So the contingency plan sounds crazy, but is actually to do nothing, because we don't think that there is anything that we would be doing to circumvent the law or to arbitrage the law, which would be beneficial to you in a way that wouldn't be closed down very quickly by the IRD. And it's not how we operate. The tax regime in New Zealand is what it is. You apply it to the funds. If there's a wealth tax, it's highly unlikely to be applied to our funds. It's very much more likely to be applied to the individuals. We're talking about income funds. Whatever happened to your guaranteed income fund? Is that still around? No, that was closed a few years ago. And the reason was there wasn't enough demand for the product which paid a guaranteed income but charged actually quite a high fee. And it was complex. It was difficult, because to get that word guaranteed in there required us to engage a third party who then had to prove their ability to guarantee to the Reserve Bank. They decided to wind up their business, so we had to wind up the fund. So if we do that, there won't be a guarantee there. We won't put that element in, but hopefully we'll come up with something which will be very, very attractive.
More questions on that at the moment. So what about Simplicity living in the South Island?
Yeah, so eventually, yes, certainly we haven't discounted it. We're starting in Auckland and we're sort of spreading south. Obviously, we need to build capacity to be able to build in the South Island, but there's some fairly logical areas you'd be wanting to look at. Christchurch doesn't seem to be a very oversupplied market in housing because of the rebuild with the earthquake, but there seems to be somewhat of a shortage in Dunedin. There may also potentially be in centres like Nelson. And certainly when we've been down and talking to the councils in Westport and Greymouth, they're quite desperate for housing down there. So you never say never. It is going to take some time because we have to, build capacity. And bear in mind, it's not just one project there. We want to be hiring people and subcontractors, so we do multiple projects. So they will tend to be in the largest cities. Yeah.
From Rob, when do you think the income fund will be launched?
We don't even know that there will be an income fund yet. We're still talking about it. I just said this is what we're thinking about doing. But now that we have funds which are producing really good sources of income, mortgages and the build to rent funds, we're starting to think, well, yes, we stick a percentage of our KiwiSaver investment diversified funds into these. Is there a product that we could go to the public directly with and say, hey, listen, you should be interested in this? So still tossing it around, very interested in members' thoughts on that, whether they'd be interested in a fund which basically helped house New Zealanders by providing first home mortgages and by building quality affordable homes for rent long term, and where the income all goes back to the members and you've got Simplicity in the middle, a non-profit, not making any money from that. Sort of be interested in that. So we're working through the possible permutations, very interested in hearing what you would like and what features you'd like it to have.
Next one from somebody anonymous. Would you ever consider tilting towards small cap and value? From my piece there, Sam, it's almost a matter of opinion, isn't it? But from my point of view, we invest in everything. We don't have small cap. The sort of medium cap is the threshold for the indices that we're in, but we've got thousands of investments in there. I think, my view overall is that the diversification is the key, and that's what we're trying to achieve. And picking either growth or value Why not have both? Have you got any views, Sam?
No, I don't, Andrew. I think it's, no, I don't. That's absolutely fine. That was answered well. Thank you.
Okay. And this person, who is also anonymous, is not complaining and prefers it this way, but what's our rationale behind avoiding emerging markets in our global funds? I mean, I know this one used to come up quite a lot in the early days now. And I'll cover it off and see if you've got any thoughts. But our view from the very beginning was that again, given the diversity of the companies we're investing in a lot of companies who are making a lot of money out of emerging markets, and that by investing in the developed markets, we were effectively covering ourselves for emerging markets. And since we've been launched, that seems to have been very much the case. The developed market indices have performed better than emerging markets, and one of the reasons for not going into emerging markets really was that they're just not as well regulated as the developed markets, and that therefore that implies a bit more risk. Is there anything else you can remember from our early days?
No, I think you said that well, mate. Yeah.
Cool. Now this one's a little longer. Bear with me. Already invested in our growth fund and in our New Zealand property share fund. Thinking of moving to Simplicity this year. So, New Zealand investment for some time to briefly talking about it. I'm keen to know who it's aimed at, the NZ economy predictions, why low numbers of NZ companies, why this when the growth fund already has 30% weighting to New Zealand. So I think that half of the question is just asking why our New Zealand share fund only owns 38 stocks. And that's simply really because the index we're following, that's the number of stocks that are in there. We exclude Genesis, Sky, and Delegates, which strips out 3, and we invest in everything else. What's really ironic about the New Zealand market, in our experience already, even at the size that we are, it's very difficult to actually invest in some of these smaller stocks. When you go any further down the list than we do, they become horrendously illiquid. Our point is from the point of view of diversification and for the liquid assets that are in our portfolios, we're happiest just taking the few that we do. Anything more from you, Sam?
Oh, that's absolutely fine.
Cool. So for the high growth fund, which is the new fund, it's invest 73% in international shares, 15% in New Zealand shares, 2% cash, 10% unlisted properties. The New Zealand and the question is, what are the shares and what are the unlisted property project returns? All this is Simplicity Living projects. So the New Zealand shares are invested exactly the same way as the New Zealand share fund. All of the diversified funds have an investment in the New Zealand share fund. They don't get charged any extra fees. The fee remains exactly the same, but they all feed into the same New Zealand share fund. In terms of the unlisted property, I don't know what are you comfortable saying about returns?
Yeah,
there,
I think
Sam?
so. Our 100-year, what we call internal rate of return, which is basically the money you make on the money you've invested over and above inflation, is between 6 and 8% above inflation. Now, in our most conservative assumptions, we could say we take it down to 5%. In our most aggressive assumptions, we could take it up to 11%, but we think 6 to 8% is a comfort zone there. That is a sufficient premium to the bonds and the other investments that would make of a similar risk nature to make that worthwhile doing. In fact, very worthwhile doing. Those are very attractive returns over the long term, but they are long-term predictions. So what you tend to find when you do properties, you make a lot of money when you develop the property and open it, and then you make less when you rent it. You can take a lot of capital gains along the way as you add value to the land and the property. But if you blend it over the long term, it ends up being a very good return.
Great. Now, a question from Jen Young. If I invested in the new international share fund, do I then not pay FIF tax as opposed to investing directly in, say, US shares? I don't know enough about the taxation of these things to answer 100%, Sam. I know that on the international shares, you'll pay what they call fair dividend rate tax, FDR. I don't know how that works when you invest directly. I think you are supposed to pay FDR tax on direct investments too.
Yes, it depends on the nature of the investor, who you are, but as a general rule, you should be, yes. So if you're in the international share fund, then you aren't paying FIF tax directly, but you are paying what's called a fair dividend rate tax. And of course, that's what the fund is paying on the assumed return of the fund. But then obviously you are paying your own personal income tax return rate, which of course tends to advantage people who are on higher tax brackets, because the maximum PIR tax rate is 28%, but there can be a whole bunch of people who are paying 39% income tax. Yeah. So, and then we just go on to Jamie. I know Simplicity had an income fund in 2017 and stopped it. Oh, there we go. Excuse me. Wonder why this didn't work last time and how the new income fund we're thinking about will be different. Well, the one that happened last time had to have a capital guarantee on it that required us to engage a third party. It needed capital put aside with the Reserve Bank. That proved to be difficult for that company to continue doing. They needed to put in a whole lot more capital as interest rates went up to provide the capital guarantee. They chose to wind up the business. They were the only people that we could contract to do that. So we had to wind up the fund. This one will not have that capital guarantee. It will not have that complexity. If we did it, it would just pay out the income that we would be receiving and the gains from the assets and then giving it to the people in the form of income, or you could leave it in the fund if you wanted to and have it grow. So Andrew, a question from Alias. I'll answer the question. I'll ask it. You can answer it. We'll switch around a bit there. Thanks for these webinars. One of the reasons all of our members are signed up. You mentioned that growth funds are heading towards approximately 7.1% return. Are you able to give an estimate for balance funds?
And now I'm pushing myself. I can never remember how the scale works, but I think I've got it. So a few years ago, the FMA approved some projections for all of the different funds going from very defensive to aggressive, as they call it, which is our high. This after tax and after fees, 2.5 for the defensive. So if you go up the scale, 2.5, that's 3.5 for conservative, 4.5 for balanced, 5.5 for growth, which would only be 6.5 for high growth. So I might have my scale wrong, but again, if you want to send us a question, send a question to info@simplicity.kiwi. I'm very happy to be categorical and let you know what those returns are. We don't predict returns. We're not, we're not allowed to, but we can't give personal advice. We can't project anything. But so those are the if you like, what the regulator has allowed us to say to project people's long-term returns at.
There's another question here. Do we have an age cycle investment fund? That means a different asset allocation depending on your age, which goes from more aggressive when you're young to more conservative when you're older. No, we don't. I know some fund managers do. We might get to that in due course, but it does require you to have a very specific asset allocation with a very specific fund. It's more expensive to maintain. I'm also a little bit concerned about something which is sort of presented as sort of like set and forget. You don't have to worry about it, because I think you should be reviewing these things, making sure you're in the right fund from time to time. But as I say, not right now.
Well, also, Sam, age is only one thing which people should be taking into consideration when they decide what fund to be in. I've always found those a little bit strange.
Yeah. The question from Georgina, I currently invest in a Simplicity growth fund. If I want to change some of that to the high growth fund, do I need to sell down and get the money back in the bank account and reinvest? Or is there a way that Simplicity can just swap it over? How does the process work? That's one for you, Andrew.
Yeah, there is a switch button. If you're in that KiwiSaver, it's quite easy. To be honest, I've already done it. In the investment funds, it's not any more difficult. But no, the simple part of the question, which is very important, is that no, if you switch between two of our funds, your money doesn't leave the market. It happens contemporaneously, and it's so in the portal on the app, there is the ability to switch.
So you just
Again,
sign into the website
if you need some help. Yeah.
So just sign into the website, go to the switch function, switch it. We do the rest. And as Andrew says, money stays invested.
We skip one, which is, will there ever be an option to move one's mortgage with a mainstream bank over to Simplicity?
Oh, yeah. That's what we call refinancing of existing mortgages. At the moment, what we've focused on is people who want to buy their first home and making life easier for them. If we get a lot more money to invest and we've satisfied all of the demand from first home buyers, then yes, we will consider reinvestment. We would have massive demand for that because we offer a rate which is very competitive. So we would have to get into some sort of ballot or lottery type system, I suspect, to ration that amount of money. Of course, we'd like to have so much money invested that we're able to satisfy everybody in that area. But of course, mortgages are a massive industry. We've got our toe in the water. We're looking after the people we think most need looking after. But if we get into a position where we can help members with refinancing, we will. Yeah.
Great, thank you. A question from Donald. Could you explain the kind of investor the single sector funds would suit? Do you want to go, or would you like me to?
Well, let's both have a go today. I guess people who are a little bit more interested in the markets and want to build their own portfolio out of the different components. So they may want to, I want more international shares or have a view on hedging. So it would suit them. It would suit people, of course, who want to be in that area, but in a diversified way. So an international share portfolio, without and just shares and just invested internationally. So I guess it would suit them as well. But it also suits obviously wholesale investors who have asset consultants who are helping them, customize their portfolios. Yeah.
Yeah, I don't think there's anything I can add to that, Sam.
Okay.
Next one is again a good question. Will we be reporting the return on investments in Blissfully Living? And I know what you're going to say, but this feeds back into a question from previously about the policeman overseeing all this, and it's something which we it's been made very clear to us that we need to make sure that we report not only on Simplicity Living but also on the mortgages and on our private equity, because we need to demonstrate to all of you that we are actually doing a good job and getting a decent risk reward on these things. So yes, we will, Sam.
Yeah, absolutely. And so far so good. Just to give you an idea of how Simplicity Living operates, when we start a project and we start building, that project accrues a return of 10% to members while it's going through the construction, because there is being value added all the time. And of course, we're drawing down on money to pay the subcontractors, buy the building materials, all that sort of thing. So investors are getting a 10% accrued return until the day that it's finished, then it's valued, and then any more or any less gets accrued to the members. And then, of course, and what we are expecting is in nearly all, if not all circumstances, there'll be another lift in valuation there. So that's quite lumpy. So that 10% is designed to smooth it out. And also, if you wanted to take money out of a fund of ours, you should get, some of the benefit of those development profits on that property, even before it's finished. And then obviously there's all the income from the rent, which just all goes into the same pot. Yeah. So that's how we do it. But it all gets bundled up into a big fund called Simplicity Living, and we will be reporting on the returns from that, as we can do also for our private equity funds and our mortgage funds, all of which so far have done what we said they would do on the tin, which is develop better risk-adjusted returns. Last question. If you could make changes to KiwiSaver or start from scratch, what would you do? Oh, have you got an hour?
Good question, John.
Look, I think there are two things now, and I think you will start to see Simplicity make some noises about this. The first thing is that we think that now KiwiSaver should be compulsory. And the reason is not because it benefits us particularly, it's because what's happening now is that a whole bunch of people who are saving in KiwiSaver are going to just be better off in retirement. There are going to be a whole bunch of people who aren't saving, even though they could. They're going to be worse off in retirement. And we think that this wealth gap that you're getting between well-off New Zealanders and poorer New Zealanders just gets stretched because you don't have people saving for their retirement. I think it's a pretty reasonable social compact to have with your citizens that if you're earning money, you should be saving a little bit for your retirement in a scheme which now has as much trust and has been proven as well as KiwiSaver has. So we think it should become compulsory so that everyone who is earning is saving a little bit. When you're not earning, you don't have to save. The second one is to get the contribution rates up. We have in New Zealand a minimum of 6%, so 3 from you and 3 from your employer. But in Australia now, is it almost 12% now, Andrew? I think it's almost hit 12%.
Working towards 12, yeah.
Yeah, so that's now saving double the amount that we are. And we think that this should go up in little increments, maybe over 6 years. You have 0.5% more from you, 0.5% from your employer. So everyone can plan for it. You can build it into wage negotiations. It's a high degree of visibility. We get ourselves up to the level that the experts and the actuaries tell us we will need to be saving at in order to give ourselves a comfortable retirement. So now the nice thing about that too is if you're saving all that money, that is more money for managers to invest. So in our case, we can build more affordable houses for rent, we can make some more mortgages, we can invest in more high startup New Zealand companies, as well as investing, the rest of the other 90% just the way we always have, which is in passive index investments all around New Zealand and all around the world. So those are the two changes: make it compulsory and have a escalation of increases over time. Anything else, Andrew? Do you have a personal wish list there, mate?
Oh, not really, no. I mean, as you know, I grew up for my first 12 years of working life in the UK and had a pension that I didn't even notice was going. And that's how it should be here.
Right. So some 4 other questions here. Very important one here. What is that cream pottery Sam is collecting, and is it a good investment? It is an excellent investment. This cream pottery here, these are Crown Lynn vases. Crown Lynn is obviously it's closed down. It used to be a pottery in West Auckland, which is where I come from. They make some very famous vases. That's just some of them there. Will they be good investments? Yeah, they keep on going up in value. But of course, we haven't bought it for that reason. We bought it because it's New Zealand. It's what we are. It's our history. And it looks nice in the office as well. A question from Anonymous: do you have plans to go back to doing something like an annuity guaranteed income fund like the previous ones? That way funds could be invested in something more like a balanced fund. The answer is no, for the reason that we mentioned beforehand. You can't get a guarantee on the capital there. But if any income product we did, you would be able to draw down as much as you wanted, as regularly as you wanted, and that would come either from, in this case, maybe the rents or the mortgages interest paid or the rental paid, and then you could also draw down on your capital if you wanted to. So a lot of, you want to have an income fund that gives you a tremendous amount of flexibility about what you draw by way of income, but there won't be a guarantee on the capital.
If I could reiterate there something you said before, Sam, is that we would be really keen to hear from people, their thoughts on that, because our sense is that what we want to produce is a fund that's relatively capital stable and that's generating income that you can draw down on. Whereas a balanced fund would probably have at least a reasonable proportion of its investments in shares, which could make it more volatile. So rather than us go ahead and design something that we think people want, as we say, any feedback would be extremely welcome.
There's a question there, just is DWS as safe as Vanguard? Well, the answer is yes, but if you don't mind me explaining why that's not a question that you have to worry about, because what happens with all of your investments is they actually go into the public trust. The public trust own them as custodian on your behalf. And so all Vanguard were ever doing, or DWS were ever doing, was actually advising us on how to make the investments. Technically with Vanguard, we were buying their funds, but their funds then, the units in those funds were held on your behalf by public trust. In this case, it's slightly different. We have the funds here in New Zealand, they're our funds, but effectively they're still with the public trust held on your behalf, and all DWS are doing are buying and selling the shares according to our instructions. So we say, we want you to buy the shares in the companies according to this index, please go away and do that. But the buying and the selling and the transacting all happens with public trust and its sub-custodians. In this case, it's called BNP Paribas, which is the bank. But the assets are held in your name always. So it sort of doesn't matter whether it's DWS or Vanguard, your investments are held by the public trust in your name, on your behalf, for you. So they are as safe, yeah.
And again, just to add, in our dealings with DWS, we've been extremely impressed with their professionalism, with their attention to detail. It's been a fairly drawn out process of getting money out of the Vanguard funds and across the DWS, but equally Vanguard have been absolutely outstanding at helping us do that. So we could never say an unkind word about them.
No, they're just there. I mean, they were there from the start. We love them, you know, and it's a shame that they couldn't manage our accounts the way they wanted to. So there's a bit of sadness there. But we found in DWS a huge asset manager, tremendously skilled in this, owned by Deutsche Bank. So, you know, and so far been doing a magnificent job for us. Yeah. There's a question here, Andrew, about valuing the private equity investments.
I've been trying to. I was going to quickly go to our website. I'm pretty certain our private equity investment policy is published, and I'm trying to remember whether it's on Disclose or whether it's on our website.
Yeah, well, it'll be on either, and you can get access to it. Very happy if you send us an email. We'll send you through how we do this. Could you just briefly describe how we do that, Andrew? So.
Sure. I mean, we've got two people in staff focused on doing this. We've got an independent entity who keep an eye on how all those various company investments that we have are going. So for the majority of our investments in terms of volume or number of investments, they're done through Icehouse, and Icehouse produce a monthly report for us on how each entity they've invested in, how they're doing, and whether they believe the value of their business has gone up or down in the month. They're also required to do that on an ad hoc basis if there's a material change intra-month. And then similarly, we have a policy that the investments that we've done directly ourselves are valued quarterly, and again with an understanding that any material change at any stage is reflected in the value of that investment. That's the sort of big picture of it.
Yeah, and we have to run those valuation policies obviously through the public trust. They have to feel very comfortable that they reflect the fair value of those investments, because of course people are pulling their money in and taking money out at any time there. Question here from Simon: will you lobby for KiwiSaver savings to be taken before tax as in most countries? Yeah, that's called a tax system, which is called there are different ways of doing it. They involve the letter E and the letter T. T means taxed and E means exempt. So there are some countries that have what you would call, and this is New Zealand, a TTE system. So it's the money that you invest, like in KiwiSaver, is up to your after-tax income. So it's been taxed. It's taxed along the way while it's in the fund, but when you take it out, it's exempt of tax. That's called TTE. That's how New Zealand operates. I think what you're talking about, Simon, is doing something like an EET, which means you can save money out of your salary before tax. It accumulates without any tax being charged, but then when you take it out, you get a big tax bill when you take your money out. It's called EET, and there are other countries in the OECD that do it that way. The reason we won't lobby for that change, and it's a very good question, but we won't lobby that change because once that happens, everyone gets used to it, and it kind of gets hardwired into the way the country operates. And it's a very dramatic change to change the way, because there then become issues of fairness. So for example, my earnings came out after tax, and so I need to get them, without tax at the end, whereas new people coming into it on a different system, and then you get different funds and different tax reporting, a whole lot of complications. So countries, once they've made that decision, don't tend to change it. In fact, I don't think I've seen I can't remember an example of it in my lifetime. I'm sure there has been one, but I can't remember. I don't think you with Andrew, anyone changing that tax structure. It's kind of hardwired into the country. Bear in mind also too that the idea is to get the investments taxed. Death and taxes are the only two reliable things in life. So it kind of doesn't matter whether they make it exempt at the beginning, they're going to get you at the end when you take your money out. So countries are pretty good, and they adjust those tax rates to make sure that they're pretty similar anywhere else in the world you go. So, and there's a comment from Anonymous. I agree with you regarding making Kiwis have a compulsory like the Aussies. I think employers should put in 6% and employees 12%. So an 18% total. Well, that would be even bigger than the Aussies. I'd love to do something better than the Aussies, but I think it would take us a long time to get to the point. But totally agree with your sentiment, which is that we should be saving more. And any changes, let's make it slow and predictable so people can get used to it. And a lovely comment from Rob. Thank you very much.
Thank you, Rob.
I think we're at the end of the questions
at the moment, unless there's any.
Oh, we've exhausted all the questions. How about that? And it's exactly 1 o'clock, which is when I need to leave to go to my next meeting. So that's just awesome timing. So thank you very much, folks. If you have any other questions, please send through an email, info@simplicity.kiwi. Feel free to call me on my personal mobile. It's 021 491 547. 021 491 547. Very happy to take any question on any subject. Just give me a call. And we'll see you soon. And any ideas you have, any ways we can improve what we do, we're just here to serve you, here to make Kiwis, wealthier. So please let us know what you'd like. And thanks very much. And thanks, Andrew.
Yeah, no, thank you, Sam. Thank you very much for everybody for logging in.
Isn't Andrew the hostess with the mostest? Isn't he best? All right, mate. See you later.
Cheers.
Bye.